Good morning or good afternoon to all the viewers, depending on where you are watching StockCharts.com. This is Larry Williams with Real Trading, and I'm very happy to be back with you one more time. And this will be our next to last. I will be doing the presentation again next week, and then it's going to be all over. I'd like to thank Zach and Rachel very much for helping me through this experience. I hope you've enjoyed my presentations here. I've certainly enjoyed doing it as well. This week, we're going to cover some more unknown growth stocks, a really interesting company I think you're going to enjoy learning about: gold, bonds, platinum, and of course, we'll have open mic questions as well. We'll also have a contest for a free subscription to my weekly market commentary. So with that, let's get going. The purpose here, my goal is to tell you what's going to happen, not what took place. We can all write about the past, but I think more significant, can we grasp a view of the future? Now, certainly my view of the future or anybody's is not perfect, but in the land of the blind, the one-eyed man is king. So we can get an idea of generally what should happen. A couple of things can take place from that view. One, if we follow that view, we know we're on track, and we'll see more of that. If we wander from that view, we know the market is stronger than the forecast or weaker. And of course, then we can react correctly to what the market is doing. Okay, let's start with a growth stock I'm certain you haven't heard of. There's the track record of the stock. Wow, look at that. Another one of these stocks that just doesn't know how to go down. And no, it's not a high-tech stock. This is actually Badger Meter. These people make meters. I mean, that's kind of a pretty boring business, isn't it? But again, when we look at the success of the stock, my gosh, it's doing a lot better than the high-tech stock. One of my ideas is that companies like this are very consistent in their growth, their revenues, their profits. Therefore, they're more stable for the investor than a high-tech stock. This company simply owns the marketplace. They make gauges. They make very heavy industrial type of applications, some retail applications. If you have a water leak, you probably have used some of their products. You don't think much about water leaks, do you? I mean, water leak, what does that mean? Is there money in water leaks? What do you think? Is there? Well, last year, water leaks wasted about 1 trillion gallons of water year in, year out. And think about 1 trillion gallons of water. What's a gallon of water worth, depending on if you're buying at a store, right? Or in your home, a lot of money. So Badger makes smart meters and industrial flow measurement tools. So it's a very specialized business. A. B, it's something that's really needed because things break, entropy prevails always, right? And as we have more environmental concerns, we have more concerns about making certain that we do use water and energy and everything correctly. And it's a hard business for anybody else to get into. So they kind of own this particular business. They're the lion people in it. Last year, revenues were $434 million. So there's a lot of money in this business. It's up from 403 million in 2017 and up from 394 million in 2016. Their operating income growth has been reliable, so it's a consistent business. Unlike a lot of the high-tech companies that yo-yo up and down, their earnings, their growth has been pretty consistent. The expected return profit growth rate over the next 5 years is almost 15%. So again, we see that same consistency, and it's a consistency that gives us this chart. Notice that it's pretty consistent. When the stock market has big breaks, it has big breaks. Short of that, it just continues in its upward trend because it's a very consistent industry. I think it's better to be invested in consistent industries than in things that yo-yo and go back up and down all over the place. So let's look at the weekly chart. This is what we're looking at now. The blue line you see in the chart is the seasonal pattern of the market. You can see typically it starts to rally about this time of the year until the middle of the year, and then it starts to come down. Professionals were heavy buyers back here right at the recent lows. They're not in the sell position now. They're not aggressive buyers. Just we expect to continue to see the trend of this market moving to the upside. It's been a strong, great growth stock and in an uptrend. If we look at my cycle forecast, we can get an idea of pretty good buying point should come up around May of this year. And we'll probably see the market, this particular market, top out around the middle of February, middle of March, have its first pullback. The stock is pretty cyclical. You can see how the cycles have operated in this market. So the cycles are to the up move in this market. Now, remember, the thing about cycles is this looks like maybe we're going to have a big down move. It doesn't mean a big down move. It just means that this should be a high and this should be a low. Cycles don't really project how big the up move is going to be. It look like we have a big down move. It says, no, we should enter a selling period and then start to see a rally. So cycles are general. They generally give us an idea of a time market will probably start to peak out about the middle of February. But for long-term investors, you definitely want to be looking for a low uh, about the first week of May. So let's look at some potential trades. We've been talking about Signet Jewelers. We know the cycle forecast we've been looking at here for the last couple of weeks is to the downside. And I expect we're going to start to see this market start coming down before much longer. Here it is on a daily basis. And it's real easy here. I'd like to be a seller at the lowest low of the last 4 days. Seasonal pattern is to the downside, a little bit of a bounce in here, but a trend change in this particular market. If we take out the lowest low of the last 4 days, I think that's a trend change in the market. So short-term traders could use that. When we also see that professionals have been selling this market, they were buying back here and buying here. They moved to the sell side now. They're selling the strength, but that's not enough to enter. As you're a trader, these markets get set up to do things, but we still need to see the trend change. Maybe you have a cycle say we should go down, or accumulation says we should go down. But we still need a trend change for proof that we're going to go down. So proof, in the case of this stock, will be trading below the lowest low of the last 4 days. We also talked about retail sales at Christmas time. We know that a lot of retail sales are very important and they stimulate growth. But I think there's a selling opportunity. We've been looking at Macy's. The seasonal pattern for Macy's start to go down, and we can see a little follow up on Macy's. This is where we are now. We've been looking at this chart the last couple of weeks, looking for the selling opportunity. Macy's is now in the point where we should expect seasonal weakness and look for and take sell signals here. Lowest low of the last couple of days would be your sell entry. The professionals have moved to the sell side of the market, just they were back here and over here. So we see that's a setup for the market to move to the downside. All we're looking for is a trend change. As a short-term trader, trend changes are really important. Some people use a moving average for that. Some might use a trend line or a pattern or Elliott wave analysis, whatever you have, whatever error you have in your quiver, you can use for a trend change. We talked about there's all these retail stocks, and they all tend to rally around Thanksgiving and into just about Christmas. But instead of following all these different stocks from Foot Locker to Office Max to Macy's and Costco's, might be easier to just look at XRT. That is the retail ETF. And again, we see that we're in the area of a seasonal decline in this market. Usually starts about now. You see the blue line is a seasonal pattern in the market. And look at accumulation in the market. We had a high in accumulation back here, and while price has been relatively strong, we have not continued rallying in this. So we've not seen a pickup in buying. So I definitely want to look, taking out the lowest low of the last 2 or 3 days here in XRT, be your sell signal. So get your questions ready. In the second half, I'm going to be doing my best to answer your trading questions. I don't know I can answer all of them. Some of them I probably can't, but with almost 60 years experience this, and I can access my charts and indicators, we get a pretty good idea of what's in store for most stocks or futures. Big question the bears have been saying is, hey, this just can't last. This bull market we've been in can't last forever. But I thought you'd enjoy this chart. This is the Trump bull market we've been in. This is George Bush's bull market. Look how long it lasted, 84 months. The Obama bull market lasted even longer. So a lot of bears are saying, well, it's got to end because it's lasted so long. Well, that's like saying your love with your wife has lasted so long, it must end. Well, that doesn't make sense, does it? Well, maybe for some people it does, but for most people it doesn't. So just because we've been in a big bull market a long time doesn't mean that it's going to end, especially if we look at the instance of the Obama and the Bush. We see those lasted almost 84 months. So I wouldn't worry too much about thinking the market's got to decline simply because it's been rallying. So contest time. Here's an interesting contest for you this week. What industry had the highest percentage of companies in that industry beating their revenue projections? If you can figure that one out, you're going to get a free 2-month subscription to my weekly service for the first person to answer that. I do a Larry TV every week where we give market commentary, show my trades that are setting up, forecast for the market, etc. We have subscribers all over the world for it. I think they really enjoy it. So again, what industry, what group of companies had the highest percentage of companies in that industry that beat their revenue projections? And if we get an answer, Rachel will let me know. So earnings really matter. And this is a really interesting number that came in. Of the 490 of the S&P companies that reported their earnings, 75% beat their earnings per share estimates. Typically about 65% beat. So if you see 75% of them beating, the economy's been really good here and these companies are doing really well. That, guys and gals, is bullish. Only 53% though of the real estate sector beat their estimate. That was the lowest of all the sectors. So that tells us real estate has not been good, largely because of retail real estate. And the energy sector wasn't very good either. Only 54% of those companies beat their earning estimates. So the weak sectors in the market have been real estate and the energy sector. So how about the strong sector? What have the strong sectors been? Maybe we'll get somebody who can answer that. Only 58% of the companies beat their revenue estimate. Now, this is important because revenues is where you're going to make your money from, right? Revenues were expected to increase by 3.8%. If you take out energy, revenue growth was at 5.2%. So revenues have been good with the exception of the energy market. Not as many companies beat their revenue estimates, and largely again because of the energy market has been a drag on companies. They have not been making the big bucks here. Other companies have been. But the revenue estimates have been beaten, and the revenues and the income have been beaten. The earnings have been beaten. That's positive. So follow me on my weekly ireallytrade.com. It's $29.95. We also have a stock course. You can go to ireallytrade.com to find out more about that. And now it's time for the answer. The healthcare had the highest percentage of companies beating. 81% of healthcare companies beat their earning estimates. Wow, that is really high, isn't it? So that's where the money has been made. So if you're thinking about dividend yield investments, the REITs, well, you probably want to be in the healthcare industry. Momentum stocks, healthcare interests. That's been the strong group. In a moment, we're going to talk about the future of the markets and what we see in store coming up, because there are some trades. I'd like to go over the Starbucks trade we had. We're talking about that, Starbucks seasonal. We thought it should rally until about 12.9, and it's done that. We had that little short-term trade to the upside. And now here Starbucks, I think, is setting up for a sell signal because we see the seasonal pattern goes to the downside. Professionals have moved into the selling area of the stock and has not been advancing in terms of accumulation. That's the red line over higher highs here. We're not seeing an accumulation distribution. So I would look for a sell signal in Starbucks. Question is where? Where would you take your sell signal? Well, as I mentioned earlier, what we want is a trend change. You could draw trend lines coming up off these lows, off the low we see over here. Again, taking out the lowest low, probably the last 3 days, something like that would also represent a selling opportunity in this stock. So while we've got the rally we were looking for in Starbucks, I think it's now time to look for a short-term sell in Starbucks. And any short-term trend change, trend line, taking out the lowest low of the last couple, 3-4 days, that should represent your selling opportunity in Starbucks. Okay, we're going to take a break now, and we'll be back with a view of the future in just a few. Well, welcome back, and here's my view of the future. And of course, I'll be taking your questions. So if you have questions, you can type those in for Rachel, and she will give them to me. As you know, I've gone from bullish to bearish. I've been very bullish on this market for a long time, and now after today's reaction in the marketplace, I'm questioning my bearishness. So on a very short-term basis, I've been wrong in this market, and that, of course, disturbed me. So what do I do as a trader? Well, first of all, I'm going to like what's really going on in the market. If I look at the internal structure of this market, I'm looking at the advanced decline line. That's the black line. I see we are at the area or close to a cyclical high in this market. So I still think we're going to have a decline until about the first week of February. This cycle has been really strong in the advanced decline line. That's called the lows. Of course, because we've been in a big uptrend, the highs have not been as significant. So that may be what's happening now. But the next really good buying opportunity, what I'm waiting for, would be around the 1st of February. And for now, I expect that we should see at least an abatement of the up move. We can look at other markets, though, to see cycles in the other markets, to see how those cycles are doing. Here we're looking at the emerging markets index. Now, this is really interesting. If we look at emerging markets, notice that while the Dow is making new highs in here, the emerging markets haven't. Their high was seen back at the first of the year. So the strength has been in the American markets. Why? Because of Donald Trump's economy and this booming unemployment we've been in, and good times have been rolling here, more so in America than in any other country. We can also look at the triple Qs, see how they're performing in the market and what their cycle forecast is. And interestingly enough, when I look at my cycle stuff in the triple Qs, which represents the NASDAQ and more growth stocks, if you will, we see about the same thing happening. We see that we should be in the area of cyclical high about now, and we would expect the market again, interestingly enough, we get that February 5th date to the downside as a next really nice buying opportunity. So from that, we look at the S&P E-minis to see what they show, and they show January 28th, something like that. But again, we're in the area of a cyclical high. The problem with cycles, it says we should go down, we go down. We don't know the magnitude of it, but suggestion time, it's a bit of a decline. I still think there's a decline coming in this marketplace. And if we look at the Dow Jones Industrial Cycle, we see about the same thing, again, somewhere in that first week of February. And the Dow is pretty cyclical. We have so much more data in the Dow. I think this is the more reliable of all the forecasts. Very short-term basis, this is a 15-minute bar chart. We've already begun this rally. This was posted last night when I made my PowerPoint. We'll rally until a little later in the day and then a pullback. Okay, let's talk about gold, and then after gold, we're going to talk about your questions that you have. I think gold was the forecast we're looking at from 2 weeks ago. The market should put in a low here and start to rally. This is an update. It was rallying well until just a few moments ago when gold broke down, but still, cycle forecasts are still to the upside. Interestingly enough, platinum has been stronger than gold, and silver has been weaker than gold. So for traders that like the precious metal markets for the cyclical up move that I think will take place, the optimal one would be platinum, and the most dangerous one to be in would be silver, because it's been the laggard in the group. If you're looking at a complex, it's really important to be long the strongest one and or short the weakest one if you're looking on the short side in the marketplace. These cycle forecasts are done using Timing Solutions software. By the way, I get questions about that, timingsolutions.com. Also, some of you will be watching this on the replay on the YouTube channel. Feel free to type in comments, and I usually reply to those. I look at them myself, so if you have questions, that's a good place to put in your questions, and I will reply to those questions on the YouTube commentary section. And it's now time for open mic. Fire away. Please write in your questions. I'm going to do my best to answer them, and Rachel will tell me what questions we have. So Rachel, are we ready?
Yes, we are ready, and I want to congratulate Mona for having the first correct answer. And Mona, just send me your email address and I will take care of everything for you.
Mona, congratulations. Okay. We look forward to having you as a subscriber to Larry TV.
Yep. Platinum. So somebody wants to know your opinion on platinum.
As I mentioned, platinum has been the real strong one in the group here. It's been stronger than gold. It's going to be in the same cycle that we just saw for gold. So until the middle of January, maybe later in January, I think this market is still going to the upside.
Okay, and the only other question I have is, what is your opinion of biotech?
You know, I don't know much about biotech, so it's really hard to wade in on that, Rachel. But here's what you can do, because people have stock charts. They can go to stock charts and see, what is the trend of this market? What's the seasonal pattern in this market? And that's probably going to give you a pretty good idea of where this market is going. If you wanted to back that up, you could look at one of the ETFs as well to see how they're doing. But this is, unfortunately, I don't have the answers to everything. This is a great case where I just don't have the answer to everything. And that's certainly one market that I'm not well versed on. So I've learned when I don't know much about things, keep my mouth shut.
Okay. And that's all for the questions right now, actually.
Okay, well, last week we had a lot of questions. This week we don't have many, so let's go back to a market that I do know a little bit about. This is the bond market. We've been talking about the bond market should have a bit of a rally here, but then move back to the downside. I've changed my view on that a little bit. Basically, I think this rally is going to last a little bit longer in here, but as you can see, our cycle projections also tell us we should start to move around the middle of December back to the downside in the marketplace. So maybe the sell-off that we saw today is the start of something. We see the seasonality of this market. The blue line also suggests we start to move to the downside. There was some accumulation. This is on balance volume is the red line. That's in StockCharts.com. Notice that prices are going lower here, but accumulation is higher here than here. That tends to be pretty bullish in the marketplace, which would represent a short-term rally. We had a nice short-term rally going in the market until some news hit this morning. We'll have to see how this market digests the news. But if we, excuse me, if we see bonds decline as they are today, maybe make a new low here, but the accumulation line does not make a new low, that would be a continuation of this accumulation that's going on, which would suggest we'd want to take short-term buys in the market because there's still, I think, a little bit more left to the upside in this market. In terms of the stock market, what to do with the S&P E-minis, I think this market is getting set up for a really nice selling opportunity. And I don't have a chart here, but I'd like to explain it to you. We have broken out to new highs here. It looks really bullish on the charts. However, the trend of momentum is to the downside here, and today's low, I think, is really significant. We take out today's low in the next 3 trading sessions, that's a really nice sell signal, something I call the specialist trap, where the market has a big up move, goes sideways, and we've really gone sideways since about the 18th of November. We've gone down, we've gone up, we've gone down, we've gone up. So we have a breakout. That's what happened today. Now, these breakouts, one of two things happen when you see a breakout in the market. You immediately fail or you continue. It's a continuation or a failure. The failure is identified, and I would look for the failure because we saw the cycles are negative here, right? We saw cycles are negative for the S&P, for the Dow, for the advanced decline line. So if we take out today's low in the next 3 days, that's a very negative scenario. In other words, the breakout didn't hold for whatever news announcement came out that was so bullish. It wasn't that bullish. If we have an immediate reversal, and that must take place in the next 3 days. So that's really what I'm looking for in here. I'm flat right now. I was stopped out of my short position, and now I'm looking to take out today's low. If I can do that, I think that's a trend change. As a trader, here's how you trade that, though. I'll put on some of my short position, taking out today's low. Again, that happens in the next 3 days, right? Then I'll want to sell more and a larger part of my position on a rally back because today's low is quite a ways away. So usually we take out these lows, we have a bounce back rally, and that bounce back rally, I'll put on the rest of my position. Here's my thinking. I definitely want to be in the trend move if we do take out that low. So I want to have some positions on, but most likely we will bounce back. And so I'm going to average out my position by trying to sell some higher than my initial entry in the marketplace. So that's the way I'm approaching this market. I think there is a selling opportunity here. But again, as I've mentioned on these television shows for StockCharts.com, I'm an intermediate term bear, but not long-term bear. The Cassandras, the purveyors of pessimism, are getting their heads handed to them again. Even a short-term bear like me is the market's broken new highs here. We are in this gargantuan bull market. There's no bear market in sight. There's no recession in sight. If you look at the recession indicators, you look at unemployment, The best measure of unemployment really probably comes from people that are changing their jobs. I do call them job hoppers. People are continue changing their jobs for higher wages or better working conditions. And there's a measure of that you can get from the St. Louis Federal Reserve System. Um, the employees are smart. They stop job hopping shortly before a recession. They know things aren't going good and they stop job hopping. Well, if you look at the job hopping numbers that just came out, they're very positive. People are still switching jobs, which means the economy is still robust. That's a good sign. I've been in the markets for a long, long time, pushing 60 years, and I've seen a lot of technical indicators over the years. Frankly, I've never seen any technical indicator that has a very good record of calling stock market highs. Some do a wonderful record of calling stock market lows, but highs, not so good. Best thing I've found to call stock market highs is recession numbers, recession indicators. When we start a recession, stock prices go down. So that's why I'm so focused on recession indicators. And the ones I keep, at least, and the ones the Federal Reserve keeps, at least, are showing that we still are in a very robust economy and there's no recession in sight, which means no bear market in sight. So the purveyors of pessimism, and there's so many of them out there, they just love to be bearish. I think they're going to be wrong again in the marketplace. That's kind of a wrap-up view of what I see going on in the stock market, especially on a very long-term basis. We're still in a really a bullish condition in the market. But can we have an intermediate term correction? I think so. I hope so. I'll be looking for that. That's for sure. And playing that. And now we know where to play that because we've had this breakout. And we can see if we have the failure of the breakout. Bonds, there's my final cycle forecast. Maybe this rally go to the 16th. We'll see. But it's a potential that I do want to look for a long move in the bond market. But we're going to wrap it up here in a moment. Again, you can follow me in my weekly market commentary where I do give buys and sells. It's about $30 a month. And of course, we have a stock course and a future trading course. You go to ireallytrade.com. There's a lot of free stuff on ireallytrade.com, a lot of lessons, courses we give you for free and stuff. So you can read about Larry Williams and my trading history, or you can Google my daughter, Michelle Williams. She's a lot more popular and famous than I am, the actress. And she's had a trading career. It's interesting that people can learn to trade from lots of different walks of life. I'm going to wrap it up with the gold forecast. Looks like we should move up there until about the 20th of the month. There's another forecast on the gold. And then we're going to go to the S&Ps. I think we're in the area of a cyclical high. Maybe right before Christmas, we start to move down again. But we know where our break point is in this market. The breakout was today to the upside. So today's low is the critical technical point in the market. I like to put a combination of technical stuff on top of fundamentals or cycles. So we know our technical breakout point is today's low is critical. And we have that, of course, on top of cycles. So I'll look for and take sell signals if they develop, looking for a move to the downside. That's it. That's going to wrap up this week's show. Remember, we have one more week left. I've really enjoyed the opportunity. I hope you viewers have as well, and look forward to your questions and comments this coming week. Until next week, this is Larry Williams wishing you good luck and good trading.